Every night, while you're asleep, $3 trillion changes hands in total darkness. No headlines, no cameras, no traders shouting on floors. Just a quiet digital network moving more money in 8 hours than most countries see in a year. It's called the repo market. And if it stops working, even for a day, the entire financial system starts to suffocate. Most people have never heard of it, but in September 2019, it broke. Interest rates that should have been around 2% suddenly spiked to 10% in a matter of hours. The Federal Reserve had to inject $75 billion in emergency cash just to keep the lights on. No one panicked in the streets because no one knew it was happening. So what exactly is this invisible pipe? And why does the stability of global finance depend on something most of us will never see? Let's start with a strange fact. Banks don't actually have enough cash. Not in the way you think. Sure, they hold deposits, they make loans, but at the end of every business day, some banks have too much cash sitting around doing nothing, and other banks don't have enough to meet regulatory requirements. This imbalance happens constantly. It's baked into how modern banking works. So they make a deal. Bank A, which has extra cash, lends it to Bank B overnight. In exchange, Bank B hands over ultra-safe collateral, usually treasury bonds. The next morning, they reverse the transaction. Bank B gets its bonds back, Bank A gets its cash back, plus a tiny bit of interest. This is a repurchase agreement, a repo. It sounds boring, it sounds small, but multiply this transaction across thousands of institutions every single night, and you're looking at a market that moves between $2 and $4 trillion daily. It's the lubricant of the financial system. Without it, banks can't balance their books, hedge funds can't leverage their trades, money market funds can't function. The whole machine seizes up. And here's the uncomfortable part. It all runs on trust and timing. If Bank A suddenly doesn't trust Bank B's collateral, the deal doesn't happen. If everyone tries to borrow at the same time and there's not enough cash in the system, rates explode. And because these transactions happen overnight, there's almost no time to fix a problem once it starts. September 2019 was a warning shot. It was the middle of the month. Corporate tax payments had drained cash from the banking system. The Treasury was also issuing a ton of new debt, which pulled even more liquidity out of circulation. And banks, still scarred from 2008, were hoarding cash to meet stricter regulatory requirements. Suddenly, there wasn't enough cash to go around in the repo market. Rates that normally hovered around 2% shot up to 10% in some trades. That's not a blip, that's a cardiac event. The Fed noticed immediately. They started injecting billions of dollars every single day to keep the market stable. They're still doing it, by the way. The emergency measures never fully went away. It just became normal. But here's where it gets weirder. The repo market isn't just banks anymore. It's also hedge funds using massive leverage to squeeze out tiny profits. It's money market funds that promise you instant liquidity on your cash. It's foreign central banks parking their reserves overnight. Everyone's in the pool, and the pool keeps getting shallower. After 2008, regulators forced banks to hold more high-quality liquid assets, like treasury bonds. Sounds safe, right? Except those bonds are the exact collateral that makes the repo market function. So now banks are sitting on mountains of treasuries they can't easily lend out because they need them for regulatory requirements. It's like being told you need to keep a fire extinguisher in every room, but also that you can't use it unless there's a fire. And when the fire starts, everyone rushes for the extinguisher at once. The irony is thick. Rules designed to make the system safer have made one of its most critical arteries narrower and more fragile. And there's another layer. Treasury bonds are considered the safest asset on Earth. The whole repo market is built on that assumption. But what happens when the US keeps issuing more and more debt? The supply of treasuries keeps growing, but the amount of cash in the system doesn't grow at the same rate. More collateral, same amount of cash, tighter squeeze. Now zoom out. The Fed has become the lender of last resort not just in crises, but on a random Tuesday in September. They've essentially become a permanent participant in the repo market, injecting liquidity whenever things get tight. This should make you ask a question. If the market can't function without constant Fed intervention, is it really a market anymore? Or is it life support dressed up as normal operations? And what happens if there's a real shock? Not a tax deadline or a debt issuance, but something sudden and violent. A geopolitical crisis, a cyber attack on the payment systems that process these overnight trades, a major institution defaulting. If the repo market froze in 2019 over a liquidity hiccup, what would it look like if trust actually broke? You wouldn't see it on the evening news right away. There wouldn't be lines outside banks. But inside the system, the suffocation would be instant. Banks couldn't settle their daily obligations. Money market funds, the ones that hold trillions in household savings, would have to freeze withdrawals. The machinery that prices every other asset in the world would start throwing off wildly inaccurate signals. And here's the thing. There's no good playbook for this. The Fed can inject cash. They did it in 2019, they did it in 2020 during COVID. But if the problem isn't a lack of cash, if it's a collapse of trust or a structural failure in the digital infrastructure itself, throwing money at it might not work.
We've built a global financial system that depends on a $3 trillion overnight handshake happening flawlessly every single night forever. And most people don't even know it exists. So the next time you hear someone say the markets are stable or that the system is resilient, remember the invisible pipe. Remember that in September 2019, it clocked. And remember that the Fed is still standing next to it, holding a very large plunger just in case. The question isn't whether it will clock again. The question is whether we'll see it coming.